Now, crude trading near $33 a barrel as escalating tensions between the US and China add caution over the prospects for a global demand recovery. International Energy Agency head Fatih Birol revived bullish sentiment, saying he sees more upside to demand. Joining me now with more is Bloomberg's Annmarie Hordern. Annmarie, great to have you with us. So let's just kick off, first of all, with Fatih Birol's comments. Bear in mind, we might not be seeing a big move today, but we've seen a 75% rally in oil this month. What makes Fatih Birol so optimistic?
Good morning, Nara. Yeah, and especially considering we went negative at one point this year, it's been a huge stabilization, to say the least, for the oil market. You know, this has been a discussion I've been having with traders, and even Bernard Looney, the CEO of BP, said it in the FT. Possibly is it peak oil demand? It's something he wouldn't write off. But Fatih Birol is saying that we haven't reached peak oil demand yet. This big question since the pandemic was, will our habits change, more people working from home, less business travel? Would 2019 be the last year that we in the world use 100 million barrels a day? And Fatih Birol is saying no. He says in the absence of strong government policies, a sustained economic recovery and low oil prices are likely to take global oil demand back to where it was and beyond. So the IEA, Nara, sticking with their view, we're going to see more oil demand increase over the next decade or so. They say before it reaches a peak around 2030. But I have to stress, this has definitely been a debate happening behind the scenes and even out in the front when you have the BP CEO himself questioning, have we hit peak demand due to the pandemic?
So what's the debate behind the scenes then, Annmarie, in terms of how much further this powerful rally we've had so far this month has to go?
Right now, the story is really about the demand pickup in Asia, and most notably in China. I don't think many people were expecting China to pick up to the levels we're seeing. We're nearly at where we were this time last year in China. So for oil that had this twin supply shock and demand shock at the same time, that demand pickup in China, one of the biggest consumers in the world, is huge. And of course, you couple that together with the fact that we are seeing ratcheting back of production on the supply side. Involuntary when you look at the likes of the United States and Norway, but then also those voluntary cuts from OPEC Plus, and even some of these big ones in the Gulf like Saudi Arabia going even further and cutting deeper. All of that is stabilizing the market. The question remains, when are we going to see it improve outside of China? Europe is still behind, the United States is still behind. So right now we are seeing demand pick up in China, but is that enough to really buoy the demand picture for global consumption, Nara?
Yeah, and it's interesting because we've discussed demand a lot there, Annmarie. You hinted at the supply side as well. I know what gave a lift to prices recently as well was the fact that we were seeing those drawdowns in Cushing particularly. But if we look a little bit further out, can we expect a quick rebound in supply from shale explorers, or is the sudden rebound in oil just going to expose the Achilles heel of shale?
Yeah, it's a really good question. This is what shale is all about. The second we have higher oil prices, they're going to want to be able to start drilling again. And you mentioned we had this record drawdown in Cushing that had certainly helped pick up on prices, and also just the fact that we had tons of shut-ins in the United States. That on the supply side has certainly helped. But the question for shale is who will come back when there is a good enough price for these shale producers to really open back up shop. Drilling activity in the U.S. really this all-time low due to these lockdowns and errors. Explorers have had to slash spending to survive this crash, and it'll be interesting to see who makes it on the other end.